So that's Tim Urbanowicz. He is the chief investment strategist at Innovator Capital Management. Tim, I've got to imagine, listen, that's Apollo. They've got their own thing. But it can't be a bad idea for your clients to have a little cash. What do they call it? Dry powder? Kelly said, when things go down, they can buy them, or should they be 100% invested right now?
Well, Brian, you always want to be focused on managing risk. That is front and center no matter what we're doing, especially when we look at the outlook season. But, Brian, we also think this year is going to be a very special one for investors where consumers get back in the driver's seat. We're viewing this as a unicorn year. OK, you have a situation.
What does that mean?
Well, investors are going to be double dipping on tax cuts. You look at what's coming from the big, beautiful bill. They're going to be benefiting retroactively from 2025, which, by the way, that money is going to be coming in February through April. And on top of that, you're going to be benefiting from less withholding in 2026. So that's a unique environment we think puts consumers in control. Spending's driving this economy, and something that can push the S&P 500 higher. We got a target of 7,600.
Yeah, I wonder. It's gone from the last couple of weeks going, wow, did you know these tax refund checks are coming? Wow, did you know to now I'm hearing it from everybody. So I'm not saying it's hard to invest when sentiment can swing that wildly, but do you think people are getting too bulled up now about the consumer in the next couple of months?
Well, I do think you're starting to see that change. If you look at consumer confidence, it's been down in the drain. It's been terrible. The last print in December looked positive.
Well,
better. So, we think that trend is going to continue with these tax cuts. And if you look at, different sectors out there, discretionary, staples, these are sectors that haven't done much of anything this year. Outside of, the value plays where customers are value hunting, they haven't done much. So we think this really can breathe some life back into those stocks.
And I appreciate, we were just talking, Tim Seymour had some skepticism about Walmart, more valuation story. You like Home Depot, Walmart, even Target turning it around. It's coming off that 12-day win streak. But you know what I can't get out of my head? $50,000 is the average price. Is it a new vehicle in this country? I think a new vehicle. I think not just any vehicle.
Yeah.
Home prices, as we know, are way high, up 50%, since 2018. So even if we're getting a little extra money next year, do you think it's going to help enough that it meaningfully changes the trajectory and this affordability crisis that people perceive?
Affordability is the number one issue. It absolutely is. It's certainly been a problem. I think that's why we've seen the confidence that has been beaten down so bad. But the other thing we have to keep in mind is we're getting to a point right now where we're starting to see the impact of the Fed cuts that have taken place over the last year. Plus, they're starting to make their way into the economy. Hopefully that helps with home prices. Obviously, Fed doesn't control the longer end of the yield curve. They don't control the 10-year. So we need to make sure inflation's coming under control. But the other thing that we see, and you tend to see inflation that follows wage growth. And we've seen wage growth start to come down. So that makes us much more optimistic on the fact that we can continue to see inflation coming down and really provide some relief to consumers. Obviously, mortgage rates are a big piece of that. That to us is still a big question mark, but there are some other bullish signs out there.
Well, you are making a pretty strong bull case for the American economy. You're bullish-ish on the stock market. 7,600 is 11%. Historically, the market returns about 8% a year. Throw in the dividend yield, you get to about 11%. So you're optimistic, but you're not wildly optimistic, it sounds like. You're not saying, we're going to be up 30 or 40% next year. It's 4 year, because we've been in a 3-year bull run. I don't need to tell you, that's been pretty incredible.
It has, Brian. And if you look at the breakdown of how bull markets play out, early on, we see valuation expansion drive the rally. That's exactly what we've seen this year. The first couple years. This year, we've seen that baton start to pass to earnings growth. We look at 2026, it's going to be all about earnings growth, okay, because the starting point is so high. And so the reason I think our target is not 20% higher from here is because we don't think you're going to get that boost contributing from valuation expansion. It's going to be all about earnings growth, and that's what we want to be laser focused on because we just don't see that. We actually think valuations are going to contract slightly this year.